Hello everyone, hope you are all doing well. Today, I'm excited to talk about India's next wealth creation window and why the coming 3 to 5 years could be incredibly rewarding for patient equity investors. We'll dive into the data supporting this thesis and explore the opportunities that lie ahead. My name is Shivaputra MC, and as a registered mutual fund distributor with AUM SIP, let's get started. The last 2 years have felt slow mainly because of a few key factors. First, we saw range-bound benchmarks, meaning that indices struggled to sustainably break past previous highs throughout 2024 and 2025. This created a sense of stagnation in the market. Additionally, global interest rates remained elevated as tighter monetary policies were in place, which kept risk appetite and valuations relatively subdued. At the same time, earnings growth cooled off to mid-single digits after a couple of exceptionally strong years, indicating what we call earnings digestion. Investors were also cautious because of geopolitical tensions, like the US-Iran flashpoints, which added an extra layer of uncertainty. So, overall, these factors combine to slow momentum and keep the market in a holding pattern. Let's look at what's changed globally, focusing on India's growth outlook. The Reserve Bank of India has been consistently revising its GDP growth forecasts upward for the fiscal year 2026. Currently, the projection stands at an impressive 8.2% year-over-year growth, marking the highest growth rate in 6 quarters as of September 2025. Another important factor is inflation, which has dropped to a record low of 0.25% in October. This significant decline in retail inflation has created favorable conditions for a potential rate cut in December. These trends highlight a strengthening economy with controlled inflation, setting a positive tone for investors and policymakers alike. Here, we see that the domestic economy is showing strong momentum. The monthly GST collections, which give us a real-time indication of formalization and consumption, have grown at the fastest pace in 13 months at 13.9% year-over-year as of June 2026. This signals increased economic activity and consumer spending. Additionally, the profit growth of companies in the BSE 500 index reached 16.6% in the September quarter, up significantly from 10.7% in June. Together, these indicators highlight that the domestic engine is running warm, reflecting robust fundamentals in the Indian economy. Here we see a major structural shift happening in the way households are saving their money. Household savings are increasingly moving towards the markets, particularly through mutual funds. The industry's assets under management currently stand at 31,781 Indian rupees crore, which is significant. What's really impressive is that SIP inflows have stayed above 31,000 Indian rupees crore for 5 straight months, showing consistent investor confidence. Moreover, we've seen 64 consecutive months of net equity mutual fund inflows since March 2021. This sustained growth is reflected in the total number of mutual fund investor folios, which now exceed 27.86 crore. These figures clearly highlight a growing trust and participation in market-based savings. Retail participation in India has grown significantly, reflected in the rise of total demat accounts, which have crossed 18.3 crore with CDSL alone by May 2026. This surge is driven largely by UPI-linked digital onboarding, making the investment process much more accessible to everyday investors. At the same time, fintech distribution platforms and increasing financial literacy are widening the investor base even further. This broader and deeper market participation is crucial because it helps make markets more resilient, reducing the impact of panic from any single group of investors. This slide explains why now is an ideal time to accumulate investments, especially during sideways or consolidation markets. These periods act as natural accumulation windows where disciplined investors buy units at moderate valuations, setting themselves up for growth during the next earnings-led market re-rating. Using a fixed monthly SIP, like investing 5,000 Indian rupees each month, automatically buys more units when prices dip and fewer when prices rise. This Rupee Cost Averaging technique helps smooth out the average entry price without the need to time market bottoms. It's a strategy centered on discipline rather than prediction, taking the guesswork out of investing during uncertain times. When we take the long view, history clearly rewards patience. Looking at the Nifty 50's rolling compound annual growth rates from 1991 to 2026, we see returns ranging from about 8.7 to 13.2% over 20-year periods. What's really striking is that these full 20-year rolling periods have demonstrated the lowest variance across multiple economic cycles and crises. That means holding investments for 2 decades has historically resulted in the tightest range of outcomes, reducing uncertainty for investors. Of course, while longer horizons tend to narrow the range of possible returns, it's important to remember that past performance doesn't guarantee future results. This insight emphasizes the value of a patient, long-term approach to investing. Let's take a closer look at the key risks we need to stay aware of in the current market landscape. First, the Nifty 50 forward price-to-earnings ratio is hovering near 21 times, so valuations aren't cheap across the board. This means investors should be cautious about potential overvaluation risks. Then, crude oil prices and geopolitical developments continue to act as major swing factors, which can cause market volatility. Additionally, the gap between GDP growth and corporate earnings has historically raised questions about sustainable demand, so that remains a risk to monitor. We also need to watch for currency volatility and foreign institutional investor flows, which can disrupt short-term market outlooks. Finally, unexpected moves in global interest rates could pose significant risks as well. On the flip side, there are some encouraging takeaways. Macro data such as GDP growth, GST collections, and corporate earnings have been strengthening, even though stock indices have remained range-bound. Moreover, asset under management, systematic investment plan flows, and growth in demat accounts suggest that market participation is structural rather than just cyclical. It's also worth noting that longer holding periods have historically helped reduce the variability in equity outcomes, reinforcing the benefits of staying invested. In fact, sideways markets like we've seen tend to reward disciplined accumulation over attempts at timing the market. Overall, staying focused on these risks while maintaining a long-term disciplined approach appears to be the prudent path forward. To wrap up, the key takeaway here is patience, not prediction. The data we've seen doesn't tell us exactly how the Nifty or Sensex will perform next month or even next year. Instead, it reveals an economy with strengthening fundamentals and a mutual fund industry supported by widespread, consistent participation. Historically, those who have stayed patient have been rewarded more often than those who tried to time the market perfectly. Use this insight to carefully consider your own financial goals, risk tolerance, and investment timeline, and whenever possible, consult with a qualified advisor to make informed decisions. Remember, mutual fund investments come with market risks, so it's important to review all scheme documents thoroughly before investing. Past performance doesn't guarantee future results.